shares in rare earth miners hit the mother lode on speculation of more White House investment. We break it down. And will AI kill hedge funds? We discuss with Anthony Scaramucci, the Mooch, founder of SkyBridge. For Friday, October 10th, it's Brew Markets Daily, and I'm Anne Berry. More market news to come, but first, the hedge fund industry. This corner of the investing world has $4.7 trillion of assets globally, a large number, but a small percent of the global equity market. Just to put it in perspective, that's about the same size as Nvidia's market cap, just one company. But hedge funds get a lot of attention, in part because some of them actively seek out the spotlight. We talk a lot on the show about activist investors, one type of hedge fund that buys up shares in a public company in order to tell it how to do things differently, often making a lot of noise in the process. Other types of hedge funds tend to be more secretive. They follow strategies such as being leverage long, a fancy way of saying they borrow money to buy stocks they're convinced will do well in the future. Another directional strategy is shorting stocks they think will go down over time. In these cases, hedge funds don't want to disclose what they're doing until they absolutely have to because unique ideas are their edge. But the best performing of these types of hedge funds get attention anyway, because when they do better than the market, their founders make astronomical amounts of money from big success-based fees. And they often go on to do highly visible things. From Steve Cohen, founder of hedge fund Point72 and before that SAC, buying the New York Mets in May 2020, to David Tepper, founder of Appaloosa, buying the Carolina Panthers. Nothing's going to grab attention more than buying sports teams. Well, with the US equity market as hot as it has been, many hedge funds have struggled to outperform it this year. And with AI tools trying to mimic the strategies of famous hedge funds and ETFs claiming to do the same for retail investors, will AI kill the hedge fund industry? Well, to unpack this, we speak to Anthony Scaramucci, founder and managing partner of SkyBridge, a global alternative investment firm that built its name putting money into hedge funds. Prior to founding SkyBridge in 2005, Anthony co-founded Oscar Capital Management, and before that, he worked in private wealth management at Goldman Sachs. You may also know Anthony as a public advocate for crypto, as host of multiple podcasts, including Open Book and The Rest is Politics, and by his nickname, The Mooch. Coming up, my conversation with Anthony Scaramucci. But first, a word from our sponsor, Capital Client Group. Now, our producer, John, and I were talking about some other podcasts that we listen to.
That's right. If you're early in your career and looking for insight, inspiration, and advice, listen to the Capital Ideas podcast.
Hear from Capital Group professionals about leaning into the differences that make you unique, making decisions that last, and what it means to lead with purpose. Available wherever you listen. Published by Capital Client Group, Inc. And now, my conversation with Anthony Scaramucci. So, Anthony, thank you so much for joining. What we're going to dig into is the topic of hedge funds. I know that you are a huge voice on crypto. We're going to come back to that another episode. But I've got in front of me your book. It's a little book of hedge funds, which I encourage everybody to read. It's got my sticky tabs in it because I've made notes and everything. And the reason that this caught my eye as a topic to dig into with you, Anthony, is there's a narrative at the moment which is AI is on a path to killing conventional forms of investing. And is it possible now for retail investors and other institutions to replicate the models of the most successful hedge funds using AI and basically extinguish the original hedge fund models?
Yes, but then also no. Okay, so let me give you the yes first, and then we'll talk a little bit about the no. So you can take elements of what people are doing and you can incorporate AI and you can use all the different analytics, technical analytics and so forth, and you can simulate a hedge fund return or hedge fund experience. And again, just to remind viewers and listeners, thank you for mentioning my book. One of the things you want to do in a hedge fund is you want to create alpha. You want to reduce the risk associated with the rates of return that you're providing such that you have a sort of a steady stream, lower volatility return, but something that's offering more consistency. And portfolio managers like using that in the context of an overall portfolio. So maybe they own some stocks, maybe they own some bonds, but they want to have some non-correlated assets in the fund. Now, that's typically what a hedge fund is. But as you and I both know, there are directional hedge funds, there are macro hedge funds, and there are, in some cases, just leveraged long hedge funds. So When I go through the different categories, leverage long, I would say yes. Macroeconomic hedge funds, generally yes. But I think you know this about life, and you know this about the fluidity of human beings. Things change very rapidly. And I would wonder if we have the sophistication in AI where the computer, the artificial intelligence could adapt as quickly as the human being. And so somebody like Steve Cohen or Izzy Englander and their staff, I would put them up against an AI right now, and I would say, well, they're better. There was a period of time when Watson couldn't beat Bobby Fischer. It couldn't beat Gary Kasparov, Watson being the AI from IBM. And then there came a time that no matter what a human being was doing, the AI was infinitely better than the chess master. And I would just say we're not there yet.
Okay.
So yes, there are certain things that it can do. And no, I would still put my money in places where I have my money, like places like Paul Singer or Steve Cohen or Dan Loeb or somebody like that. But I just want to make one last point, because I think this is an important one. If you remember, I have, by and large, for a good part of my career, run a fund of funds. And so a fund of funds, if you're not careful, is like a typewriter business. Okay, so hear me out. We were very popular 05, 06, 07. And then people got killed in the financial crisis. We became exponentially popular. And then people started figuring out a way to directly invest, or there were ETFs created that were generating some types of alpha or replication returns like the ones you're discussing. And we became slightly less popular. And then people said, okay, I can go to a retail wirehouse, put $50,000 in a retail wirehouse. They'll create an omnibus account for all their investors, and they'll give Steve Cohen $50 million. It was a way to avoid the $15 million minimum that he had. And so retail investors were getting access directly into hedge funds. And so you'd say to yourself, okay, well, now that fund of funds is obsolete. But what I did with that fund of funds is I flipped it and turned a large component of it into digital assets. And that created a very high return profile. I feathered it with some hedge funds. And I'm not sure AI is going to have the facility or the 36, 37 years of market experience that me or someone like my partner Brett Messing has to see that trend in 2020. Now, maybe, I bet you if we're having this conversation 5 years from now, we'd be saying, okay, yep, AI has replicated a lot of stuff. It's knocked a lot of people out of business. Won't knock everybody out of business, just the way the nature of things. But I don't think it's there yet.
Let's talk about ETFs and then take that as a proxy for the market or the diversified baskets more broadly. And again, coming to it with the view of a retail investor, you take a look at the ability of the retail investor now to go and buy into ETFs or to just go buy baskets at very low cost. And then I look at the performance of some of these hedge funds, and it's interesting. Bloomberg just put out a very interesting chart that shows the performance of some of the biggest hedge funds so far through the end of September in 2025. And other than call it the top 10 or so, most of the others underperformed the S&P 500. So right. When we look at that, how do you say to folks, hedge funds are still going to be worth their expensive fee structure?
So it's such a great question. And again, I'm not an apologist for the hedge fund community, because ultimately Buffett's right. For a large slug of your assets, you should just put it in the S&P 500 and sit on it and wait on it. And you should be able to do very well over long periods of time. So I'm not an apologist for the industry. But I guess what I would say is you've got to peel back the onion a little more. You got to say, okay, if that's a private equity return, and it's giving me 10%, and it's had very low correlation to the S&P 500, a lower beta than the S&P 500, and so it's underperforming, but it's doing better than bonds in general and less than stocks. It's in a sweet spot where I may want to have that return, even though the fees are being charged, and it's a net of fee return. If I'm in a hedge fund that has had historical absolute mid-single-digit, low double-digit returns with very low volatility, and again, it's not a Bernie Madoff strategy where it goes up into the right every day until the person's discovered and they go to jail for 80 years. So of course there's wins and loses in the strategy. It's a measured return, right? As you know, there's a measured risk in our business. How many units of risk am I using to generate that return? What's my Sharpe or Sotino ratio? Not to bore your people, but these are just mathematical ratios that would tell a capital allocator if the return is worth the risk that they're taking, or is it alpha? Is it better than the actual risk that they're taking? And so I would say, I think there'll be room for the bigger players always, because consultants go to big institutions and say, yeah, over this XYZ period of time, Steve Cohen did this, or Izzy England did that, and a result of which you should stay in those funds. But if you are making a statement to me, and we're both experienced people on Wall Street, and you're saying to me, are hedge funds worth it? And I would say to you, for the average person, maybe not. But for somebody that's got a reasonable amount of money, maybe so. And what I mean by maybe so is units of risk, large institutions thinking long term will want to be in those hedge funds. But listen, I'm in the industry. I may be biased. I'm not trying to talk my book. I think we've done a good job for investors. I think we've delivered reasonably to very high rates of return over time. I've got my money in the products that we're offering to our clients. And I think people generally, look, we had a great year last year. I'm not allowed to talk about the performance publicly, but if you have 40% of your money in Bitcoin and it goes up 80%, trust me, you're doing pretty well, right? So to me, I guess what I would say is we're in a period of change. There'll be less hedge fund managers. You referenced that book. I wrote that book 13 years ago. I predicted in that book that assets would go from $2 trillion at that time to $6 or $8 trillion. I got it wrong. They went from $2 trillion to $4 trillion. And so even if we just had market performance, and it would have been $7 trillion. But we didn't, because what ended up happening is people said, no, we don't want this. We'd rather have the S&P, or we'd rather have something else. And we were also in an age of dramatic liquidity. What I couldn't predict in 2012 when I wrote the book was the quantitative easing would last a decade. Right. Did not predict that. And so when you have zero interest rate policies, your longs are going to go up probably more than you anticipated, but your shorts are going to go up, because a rising tide of zero interest rate policy would lift both. So, if you're outperforming on your longs but your shorts have gone up, you've taken yourself below the S&P 500. You see what I mean? And so, but that's normalizing now. We've post COVID, we moved into a little bit more of a normal rate environment. We're off zero. There's some inflationary pressure in the system, and it may create more of an opportunity for hedge fund managers. But I think the sentiment for hedge fund managers is over. And hear me out for one more second. I don't know. Lots of people in my industry think we're in the investment management business. I think we're in the fashion business.
Interesting. We'll dig into that. Yeah.
But yeah. The skirts go up, the skirts go down. When I started in the business, there was a biotech craze. Then we moved into semiconductors.
Yeah.
Then there was a craze for the internet and things like pets.com. Then we migrated out of that into, other types of assets, the cloud, the digital economy.
Yeah.
And then we went into digital assets like Coinbase and crypto, picks and shovels. My point is, we always have a new fashion.
It's a different kind of risk, it feels, though, right this moment, Anthony, even different from the semiconductor boom, different from what we saw in 2007. And that's just the sheer level of concentration we're seeing in the equity markets right now. I think it was David Tepper I saw say in an interview recently that he looks at that and he looks at the valuations and says, I hate them in the markets because I don't see where else it goes right now other than a direction I don't like. When you look at, call it 30% plus of S&P 500 market cap sitting in the Mag 7, do you look at that and say, I just don't know how you play in that kind of world, how you invest and diversify to try and find alpha?
So, It's difficult, okay? And I'm going to give you another stat that I want you to think about, okay? It's not just a Mag 7. Let's extend it a little. If you took the top 20 largest companies in the United States, they have a market cap now equal to U.S. GDP.
Wow.
Right. And again, we're talking about NVIDIA, 4.5, 4.6 trillion.
Yeah.
And yet, if you looked at the top 20, you said, okay, well, what are the net profits on the top 20 companies? Well, it's approximately 200 billion. So you got a 28 plus $1 trillion market capitalization with $200 billion worth of profits. And so that is a glaring red light flashing on the economic and the markets dashboard. Somebody that's been in this industry for 37 years, I'm looking at that light and I'm saying, okay, these prices are potentially unsustainably high. We have a mutual friend named Andrew Ross Sorkin. He's writing a book, or just finished writing a book, called 1929.
Yeah.
I have an advanced copy of it. I'm going to bring him on my author's podcast. I'm about a quarter of the way through the book, and the legendary finance professor by the name of Irving Fisher, 3 weeks before the crash, tells people publicly that stocks have reached a permanently high plateau. And that was the level of confidence they had. And lo and behold, there was a 90% decline 3 weeks later on the 29th of October, 1929. And so I say to you that, could there be a big correction and so forth? I believe that there would be. And then the question is, who's going to be the most skilled to handle that correction? Well, take a look at Tepper, take a look at Steve Cohen and Izzy Englander during the global financial crisis, or large-scale corrections. They had a tendency to preserve capital. And so that you could be in a corrective moment, and then all of a sudden hedge funds all of a sudden become more in vogue because hedge fund managers do a better job of conserving capital than long-only ETFs or directional managers.
It's interesting because you're honing in, Anthony, on really seasoned, very, very well-known hedge fund managers who've been around doing this for a very long time and doing so very successfully.
Multiple cycles.
Multiple decades, multiple cycles. There's a sense of they've seen it all, right? And then you've got the Ray Dalios as well, who's now being very vocal, and others, big asset managers. On the other end of the spectrum, though, let's talk about who's been successful raising money to become the next generation of asset manager or hedge fund manager. Do you remember seeing this article about a 23-year-old ex-OpenAI engineer who raised a $1.5 billion hedge fund, I think it was last year, with no investing experience whatsoever? And he went out and has said, here's what my skill is going to be. I'm going to be better positioned than your traditional money managers at spotting the next AI trend. And when I read that, I thought about Cathie Wood, who for ARK, for her firm, famously says she won't hire finance people, she hires scientists. How do you think about that? How do you think about folks who are not at all what you're describing, which is the legendary seasoned financial people, but the actual scientists looking at the underlying products of these companies?
So it's such a great question. So I love people like that. I want to have people in the industry or in the mix at SkyBridge that are differentiated. I don't need them to be pure finance and former Goldman Sachs brokers turned hedge fund managers. I don't need that. I would say that the younger people in SkyBridge actually directly influenced our decision-making in morphing SkyBridge into more of a digital economy, digital asset hedge fund manager. You know, I would give, if I was going to give my old fogey self some credit, is that I didn't remain generationally anchored to the conventional thinking in my generation, because, you know, guys that I really respect, Jamie Dimon, Bitcoin's a pet rock, decentralized. You know, Larry Fink hated Bitcoin before he loved it, you know, it's that sort of thing. And so what you're describing is, and I know, and it makes sense to me why there would be money available for this, okay, because $1.5 billion is a lot of money, certainly, but it's also not a lot of money in the grand scheme of $57 trillion of assets. And somebody that has that skill set, I could see a lot of people wanting to test that skill set, seeding that business, particularly if the kid demonstrated his adroitness in dealing with and handling, adapting artificial intelligence models to trading. So I'm all about that. I'm open-minded to all of that. I have a big summer program at SkyBridge. I hired a very eclectic swath of people because I feel like I don't want to be that generational snob. You know, we have generational snobbery, by the way, on both sides, right? We have Mandami in New York. He's a generation younger than Andrew Cuomo. He thinks he knows everything. And then you have Andrew Cuomo that thinks that Mandami knows nothing. You know, and we do that in Wall Street too. You know, I watch younger people on Wall Street come up with these really cool ideas, really smart concepts, and I watch older people poo-poo them, you know, tap them on the head and say, "Sonny boy" or "Sonny girl," you know, you're just getting started. You don't know what you're talking about. So I want to always be open to that and always neurally plastic. But yeah, I could see how he raised $1.5 billion, and I could also see how people like that could change the narrative of the hedge fund industry. Why couldn't somebody that raised $1.5 billion as you're describing, has great AI modeling, great artificially intelligent computers that can help assess markets, is doing well in those markets, that grow into $100 billion fund? There's no reason why that couldn't happen. So for me, I'm open to the stuff. You asked something, though, if you don't mind, I want to go back to it because I think it's a really relevant and very intellectually sharp question. You're basically asking, have the hedge funds aged out?
Correct. That's what I'm asking.
Basically asking that. And the short answer to me is no, they haven't. Will the hedge fund managers age out? And I think the answer to that question is yes, they will. But then the secondary question to that is when. And so I don't know, but is it 5 years from now? I think it's 5 to 5 years plus from now. I don't think it's in the next 1 to 5 years. That's just me. And, you know, when I was at Singularity University 2014, Ray Kurzweil was talking about singularity is near. He wrote a new book now called Singularity is Nearer.
Yeah.
He was talking about robotic technology that was going to drive cars. And by 2025, we were going to be in a driverless car world with robo-taxis and all this other stuff. Are we there? Sort of. But we're not 100% there.
I want to come back to this point about neuroplasticity. It's such a, first of all, great word. Thank you. I always like it when the vocabulary gets boosted. One way in which I think, as an observer, you stay very curious and neuroplastic is you're a voracious reader. You host multiple podcasts. You've got one called Open Book. And I'm assuming, is that the one that you're going to be interviewing Andrew Ross Sorkin on?
Yes. Yeah, I interview authors on that book. And so, you know, I have probably do 2 of those a week. I keep them to 30 minutes. But I tell people, you know, I'm a big lover of authors. I mean, I love books, but I love an idea of an author working months or years on a project. It'll take me $10 to $35 to buy his work, 10 hours to read it, and I'll get 10 years of experience from an author. You know, Jim Mattis, our former defense secretary, said it better than me, so I'll share what he said. You're not equipped to go through life without reading, meaning you need other people's life experience, you need their words, you need their insights, you need the insights from the ancients and from maybe even the Eastern philosophers as much as you need contemporary insights. And if you don't read, you're overly limiting your life experience. So in a world that's very focused on social media, I try to stimulate the idea of reading by interviewing the authors, because the authors are obviously passionate about their work, and hopefully it'll drive people towards their books.
How do you find time? You're a dad, you're a fund manager, you're a public person, you're a host. Yeah. Where does the reading slot in?
Well, I'm a big believer in Audible and audiobooks. I'm a big believer that if I'm going to go out for a run, that's 45 minutes worth of listening, which is probably the equivalent of a half hour of reading. If I'm going to be in the gym and it's something I'm doing, maybe not weightlifting or something like that, I'll probably be listening to something or taking in a podcast or doing something like that. And I'm a big traveler. You know this because I travel all over the world for my business. And so this past month, I've probably been, I'm almost embarrassed to admit this to you, I've probably been on a plane 35 or 40 hours, almost a full work week on a plane. And I'm not a big, user of plane entertainment. I will listen to a book or read a book or immerse myself in something that I'm trying to learn about. And so it's just the intellectual curiosity I have, different from other people. I'm not a big Instagram scroller, and I'm not a big Twitter scroller, although I use Twitter because I think it's an interesting device to aggregate news. So, I mean, that's how I do it. And by the way, I'll just tell you this, 10 pages a day in a year's time is 3,650 pages. Okay, that's 100 books. Okay, so if you do 20 pages a day, which I do, that's 200 books. Okay, and so it adds up. And by the way, if I don't like a book, and I'm done. I don't waste my time. I'm not a plate finisher.
Well, a final thought for you is with respect to podcasting, Anthony. We're about week 7, week 8 into this daily podcast. So every single day we drop at 4:30, about 25-ish minutes long. Give me some advice. What have you learned from launching podcasts that we should be taking into account?
Well, I mean, you don't need the advice from me because you're already skilled and you've got great instincts. But I'll tell you how I think about the podcast business. You know, if I'm on the radio and you're driving in the car, your brain is making an assumption that 10, 100, 100,000, 30,000, 50,000 people are listening alongside of you. It's a different impact on your brain. If you turn on the tube and I see Barry on CNN or CNBC, there's an assumption she's speaking to an audience of several 100,000. But if I'm on a podcast with Ann Berry, I'm now in a parasocial situation because it's an intimate thing. The podcast listener has earbuds in, they're walking in the woods, they're walking on their daily walk, and there's 3 people in the room. It's them, the 2 podcast hosts, or the podcast host and her guest, and the third person. And so you do this already, but I would say to anybody that was starting a podcast, dial into the intimacy of that. Dial into and be vulnerable and be real and tell people, you know, people know when you're talking with spin. I could have spent 30 minutes here spinning you on all the positivities of the hedge fund space. I told you what I like about the hedge fund space. I told you what I don't like about the hedge fund space. I explained that your preposition, your theory is going to be true. Okay, and that's negative on the industry, frankly. But I think when people hang up and they end the podcast, like, all right, well, at least that guy's a straight shooter. He's telling me what he really thinks, and Ann Berry's either getting it out of him or she's also sharing what she really thinks. So it's a one-on-one conversation that a third party gets to be a voyeur in. And they're dialed in that way, right? That's parasocial. That's not using it as a news medium across a very large spectrum. So think about it that way. And your podcast, you know, look, you got the mojo. You know, you have you have what my kids call the Riz. You know, you got the Riz.
You.
So, you know, if you have the Riz, you got the Riz, and you know you have the Riz.
You know what? Maybe I'll wear a T-shirt that says I got the Riz once in a while. We'll see. We'll put it under the blazer. Anthony Scaramucci.
You got that British, you know, low-key, non-braggadocio nature about you, but you have the Riz, and I know you have the Riz, and so use it. Use the Riz, girl. That would be my advice.
It's the baking soda. It's the baking soda. Anthony Scaramucci, thank you so much. Come back. We'll look out for your next book, and we'll chat crypto. Thank you, sir.
Thank you. It's great to be on with you.
Well, big thanks to the Mooch for joining us. It's 4 p.m. on the East Coast. There's the closing bell. The market's wrapping up. So, John, did anything in the markets catch your attention this week?
Yes, word that the U.S. government has acquired a 10% stake in Trilogy Metals to support the development of Alaska's Ambler mining district, which is rich in copper and cobalt. And add this to last week's announcement that the U.S. government is restructuring its deal with Lithium Americas to take a 5% stake in the company, and a lithium mine is developing in Nevada. And of course, the deal in July for the Department of Defense to become the largest shareholder of rare earth miner MP Materials. Then just yesterday, shares of U.S. Rare earth miners surged across the board after China tightened restrictions on critical mining exports, fueling market speculation that the White House will continue to invest in building out a domestic supply chain.
A lot going on in the minerals space, something we're going to keep watching, a lot more speculation that there's more activity to come. Well, Monday is a holiday for many of you. While the equity markets will be open, the bond market will be closed. And I know that a lot of schools are going to be off on Monday as well. So for those of you getting a long weekend, enjoy it. But no matter what you're doing, holiday, working, trading or not, tune in on Monday because we're going to be back with a very special episode. That's it for today's Brew Markets Daily.
Brew Markets Daily is hosted by Ann Berry and produced by John Crotteau, Tariq Abdellatif, and Emily Milliron. Our technical director is Uchenna Waogu, guest booking by A.B. Silver. The president of Morning Brew Inc. is Devin Emery.
Wake up every morning with the Morning Brew newsletter and tune in to Neil and Toby on Morning Brew Daily. See you back here next week. Have a great weekend.